Silver is facing a very unusual battle right now because two completely different forces are pulling the metal in opposite directions. On one side, the latest weak U.S. payrolls data has reduced pressure on the Federal Reserve to keep monetary policy tight, creating a potentially supportive environment for precious metals. On the other side, a new tariff affecting polysilicon is raising a much bigger question for silver investors. What happens if one of silver's most important industrial demand drivers starts facing higher costs and slower growth? And that is the story I want to focus on today. Because if you only look at silver through the lens of interest rates, you could miss an important risk developing underneath the market. And if you only look at industrial demand, you could also miss the powerful monetary forces that could continue supporting silver. This is exactly why silver is becoming such an interesting macro asset. Welcome back to Macro Bullion. I'm Alex James, and today we're looking beyond the simple question of whether silver is going up or down. We're asking a much more important question. Can monetary easing overpower a new industrial demand threat? The latest Kitco market report highlighted a significant reaction in precious metals after weak U.S. payroll data reduced pressure for further Federal Reserve tightening. That is important because interest rate expectations are one of the major drivers of gold and silver. When economic data weakens, investors can begin pricing a less restrictive Fed. If that pushes Treasury yields lower and reduces support for the dollar, precious metals can benefit. That is the bullish side of the equation. But then we have the industrial side. Recent reporting has focused on a Trump administration tariff affecting polysilicon, a critical material used throughout the solar supply chain. And this matters for silver because photovoltaic technology is one of the major industrial applications for silver. Silver is not simply a monetary metal, it is also an industrial input. That creates a completely different demand profile from gold. Gold can benefit when investors become nervous about inflation, currencies, interest rates, geopolitical uncertainty, or financial stability. Silver can benefit from many of those same forces, but it also depends on industrial activity. And solar is particularly important because silver is used in electrical contacts and conductive applications within photovoltaic cells. That means any major policy change affecting the economics of solar manufacturing and deployment deserves attention from silver investors, but we need to be precise here. A tariff on polysilicon does not automatically mean silver demand is about to collapse. That would be an oversimplification. The real question is how the tariff moves through the supply chain. Does it increase production costs? Does it change solar panel economics? Do manufacturers absorb the higher cost? Do developers delay projects? Does production shift to other countries? Does technological substitution reduce the amount of silver required per solar cell? These are the questions that actually matter for silver. And there is another important point. Silver demand can remain strong even if one individual segment experiences pressure. Industrial demand is broader than solar alone. Silver is also used in electronics, electrical applications, medical technologies, automotive systems, and other high-conductivity applications. So we should not take one tariff announcement and immediately turn it into a bearish silver forecast. Instead, we need to understand the potential transmission mechanism. If the tariff ultimately makes solar deployment more expensive, it could create a headwind for future silver demand growth. But if silver prices are simultaneously receiving support from lower interest rate expectations, a weaker dollar, investor demand, and constrained supply, those forces could offset part of the industrial pressure. That is what makes this setup so interesting. You effectively have two different silver markets operating at the same time. There is monetary silver, the metal responding to the Fed, rates, yields, the dollar, inflation, and investor positioning. And there is industrial silver, the metal responding to manufacturing, solar, electronics, technology, and global economic growth. When both sides move in the same direction, silver can become extremely powerful, but when they move against each other, volatility increases. And right now, that conflict is becoming increasingly important. The weak payrolls data has potentially strengthened the monetary argument for silver, but the new tariff story forces investors to ask whether industrial demand can continue expanding at the pace the market expects. So don't look at this as simply a bullish or bearish headline. Look at it as a test. Can monetary demand keep silver supported if industrial demand expectations begin to weaken? And more importantly, could this tariff actually accelerate changes in the solar industry that eventually alter how much silver is required per unit of solar capacity? Because if that happens, the silver market could be facing a much deeper structural question, one that has nothing to do with tomorrow's Fed meeting. To understand why this tariff story matters for silver, we first need to understand the solar supply chain and where silver actually enters the equation. Because the headline can make this sound much simpler than it really is. A tariff on polysilicon does not directly tax silver, and it does not automatically destroy silver demand. The potential impact comes through the economics of solar manufacturing and deployment. Polysilicon is a highly purified form of silicon used to manufacture photovoltaic wafers and solar cells. Those cells then become part of solar panels that convert sunlight into electricity. Silver is used in conductive components of many photovoltaic cells because of its excellent electrical conductivity. So when solar capacity expands, the industry can require significant quantities of silver. That creates an important connection for silver investors. The chain is essentially polysilicon policy to solar production costs to solar deployment to photovoltaic manufacturing to silver consumption. The further down that chain we go, the more uncertain the impact becomes. A tariff can increase the cost of imported material, but the manufacturer does not necessarily absorb the entire cost. Some of the burden can be passed to customers. Some companies can change suppliers. Production can move to different regions, manufacturers can redesign supply chains, and technology can continue reducing the amount of silver used in individual cells. That last point is especially important. Silver demand from solar is not determined only by how many panels are produced. It also depends on silver intensity, how much silver is required per unit of photovoltaic capacity. If solar installations continue growing but manufacturers use less silver per cell, total silver demand may grow much more slowly than the number of solar panels suggests. This is one of the most important structural issues for the silver market. Investors sometimes look at the growth of renewable energy and conclude that silver demand must automatically explode. But technology is constantly changing. Manufacturers have strong incentives to reduce the quantity of expensive materials used in production. Silver is valuable, and industrial users have every reason to improve efficiency. That means the silver story is not simply more solar equals more silver. It is closer to more solar times silver intensity per unit times technology trends equals potential silver demand. And that is a much more complicated equation. Now add tariffs to the picture. If the cost of solar manufacturing rises, developers may delay projects if expected returns become less attractive. Some projects could still move forward because of long-term energy policy, electricity demand, subsidies, or strategic considerations. Others could be redesigned or shifted geographically. So the impact on silver demand could be delayed rather than immediate. This is important because commodity markets often react to expectations before physical demand actually changes. If traders believe solar deployment is going to slow, they may price that risk into silver before factories reduce production or before physical silver consumption falls. On the other hand, if the market concludes that the tariff will have only a limited effect on global solar deployment, the initial silver sell-off could prove temporary. And there is another factor that makes this story even more complicated: the global nature of the solar industry. A policy change in the United States does not automatically translate into the same reduction in global solar demand. Solar manufacturers and developers operate across multiple countries and regions. If U.S. projects become more expensive, international demand could continue growing. Companies can also adjust supply chains. Materials can be sourced from alternative suppliers. Manufacturing can shift, projects can move between jurisdictions, and governments can respond with their own industrial policies. So the actual impact depends on how the global industry adapts. This is why I would be careful with dramatic headlines suggesting that one tariff has suddenly destroyed silver's industrial bull case. It hasn't. But it has introduced another variable that silver investors need to monitor, and that variable is solar economics. Now let's connect this back to the broader precious metals market. Silver is currently receiving potential support from the monetary side because weaker U.S. payroll data has reduced pressure for further Federal Reserve tightening. If the market begins expecting lower rates, that can support precious metals through lower yields and potentially a weaker dollar. So we have a fascinating contradiction. The same macro environment that can make silver more attractive as a monetary asset could simultaneously raise concerns about economic growth and industrial demand. That's why silver can behave differently from gold. Gold can rise because investors believe the economy is weakening and the Fed will eventually ease. Silver may initially rise for the same reason, but then investors ask a second question. If the economy is weakening, what happens to industrial demand? That question becomes even more important when a major industrial sector is facing policy uncertainty. This is also why the distinction between short-term and long-term silver demand matters. A tariff headline can create immediate volatility, but the long-term silver thesis depends on whether global industrial consumption continues expanding faster than supply and whether technological demand remains strong. And supply is another piece of this puzzle. Silver production is unusual because a large portion of global silver output comes as a byproduct of mining other metals. That means silver supply does not always respond quickly to higher silver prices. A company may not simply open a new silver mine because the price rises if its economics are primarily determined by copper, lead, zinc, or other metals. That can create a supply-side constraint. So even if solar demand growth slows somewhat, silver could still find support if mine supply remains constrained and investment demand strengthens. This is why we need to look at both sides of the physical market. Demand growth matters, supply flexibility matters, technology matters, monetary policy matters, and investor positioning matters. The tariff story is therefore not a simple bearish signal. It is a new variable entering an already complicated silver market. And now we have to ask the next question. If the Federal Reserve is becoming less worried about additional tightening because of weak payrolls, could monetary demand actually overpower the industrial policy risk? That is where the gold versus silver comparison becomes extremely important, because if the Fed moves toward easier policy while industrial demand remains resilient, silver could have a powerful combination of catalysts working in its favor. But if easier policy arrives because the economy is deteriorating sharply, gold may become the cleaner beneficiary. We'll examine exactly that conflict, the Fed Treasury yields, the dollar, gold, and silver, and why the same weak economic data can be bullish for gold while creating a much more complicated setup for silver. We'll break down the solar connection more carefully, examine why polysilicon matters to the photovoltaic supply chain, and explain why the real silver risk may not be the tariff itself, but what happens to solar deployment and silver intensity after the tariff hits. Now we need to move from the industrial side of the silver story to the monetary side, because this is where the latest weak payrolls data becomes extremely important. The market is no longer looking only at whether the economy is growing. Investors are asking whether the Federal Reserve has enough evidence to stop worrying about additional tightening and eventually start thinking about easier monetary policy. That shift can be extremely important for gold and silver. The latest Kitco market report highlighted the reaction clearly. Precious metals rallied after weak payrolls reduced pressure for further Federal Reserve tightening. That is the first major piece of the puzzle. When employment data weakens, investors naturally start asking whether interest rates have become restrictive enough to slow the economy. If the answer is yes, expectations for future rate increases can decline, Treasury yields can come under pressure, and the dollar can lose some of its support. That environment is generally constructive for gold. And because silver also trades as a monetary metal, silver can benefit too, but there is an important difference. Gold does not need strong industrial growth to justify its role in a portfolio. Silver does. This is where the current setup becomes complicated. Imagine the economy starts weakening significantly. The Fed responds by becoming more dovish. Treasury yields fall, the dollar weakens, gold rises. Silver could initially rise alongside gold because the monetary environment is becoming more supportive, but then investors have to ask whether the economic slowdown is severe enough to reduce industrial demand. That second question could limit silver's performance. This is why silver can sometimes lag gold during the early stages of a recessionary shock, even when interest rate expectations become highly supportive. The market is essentially saying gold benefits from the monetary problem, silver has to worry about the economic problem, but that relationship can change later. If monetary easing succeeds in stabilizing the economy, improving liquidity, and encouraging investment, silver can become much more attractive because it combines monetary sensitivity with industrial exposure. That is the scenario silver investors really want, not simply a weak economy, not simply lower rates, but lower rates combined with a stabilization in economic growth. That is potentially the sweet spot, and this is why the next few weeks of economic data matter so much. The payroll report is already sending one message: the labor market is losing momentum. Now, the market needs to determine whether that weakness is temporary, whether it is becoming structural, and whether inflation is cooling enough for the Fed to respond. If inflation also moderates, the probability of a more dovish policy path could increase, and that could push Treasury yields lower. For gold, falling yields can be particularly important because they reduce the opportunity cost of holding a non-yielding asset. For silver, lower yields can attract investment demand, while a weaker dollar can make dollar-priced commodities more attractive internationally. But again, we cannot stop there. We have to ask what the dollar is doing. The dollar is one of the most important variables for precious metals because gold and silver are generally priced in US dollars. A stronger dollar can create pressure on commodities, while dollar weakness can provide a tailwind. If weak US economic data continues to reduce expectations for restrictive Federal Reserve policy, the dollar could face additional pressure. That would potentially provide another layer of support for precious metals. And this is where the monetary argument could begin to compete directly with the industrial tariff story. Suppose the tariff creates concern about solar demand. At the same time, treasury yields fall, the dollar weakens, and investors increase allocations to precious metals. Silver could still rise despite the industrial headwind. That would tell us something important. It would mean the monetary and investment demand components are powerful enough to offset concerns about one industrial sector. But if silver begins underperforming gold while the dollar strengthens and yields rise, that would tell us the opposite. It would suggest the industrial growth concern is becoming more important. This is why the gold to silver relationship is worth watching. Gold and silver don't always move together at the same speed. If gold rallies strongly while silver barely moves, investors are probably seeking safety and monetary protection. If silver begins outperforming gold, the market may be shifting toward a more aggressive precious metals environment where investors are willing to take greater exposure to industrial and higher beta assets. That distinction could become one of the most useful signals in the current market. Now let's consider the Federal Reserve itself. A weak payroll report does not automatically mean rate cuts are coming. The Fed still has to consider inflation. If inflation remains elevated, policymakers may be reluctant to move aggressively. This is why the upcoming CPI data becomes critical. If we get weak jobs plus cooling CPI plus falling yields plus weaker dollar, that would create a powerful dovish combination. Gold would potentially have a strong macro backdrop. Silver would have the same monetary tailwind, but its industrial story would remain the question mark. Now imagine the opposite. Weak jobs plus sticky CPI plus rising yields plus stronger dollar. Suddenly the Fed has less freedom. Precious metals could face short-term pressure, and silver could face additional pressure because investors would have to deal with both restrictive financial conditions and concerns about industrial demand. That is the scenario silver bulls need to watch carefully, but there is also a third possibility. What if inflation cools, the Fed becomes more flexible, yields decline, but economic growth remains relatively stable? That could be the most interesting environment of all, because then silver would not have to choose between its monetary and industrial identities. Both sides could work together. Lower rates could support investment demand. A softer dollar could support commodity prices. Stable economic activity could support industrial demand. Solar investment could continue despite higher input costs. And constrained silver supply could amplify the effect. That is the bullish silver setup, but we should not assume it will happen. Markets rarely give investors a clean signal. The key is confirmation. If silver rises because of weak payrolls but then fails to respond to improving monetary expectations, that would be a warning. If gold continues higher while silver catches up and eventually outperforms, that would be more constructive. And if silver starts breaking higher at the same time that treasury yields decline and the dollar weakens, the market would be sending a much stronger signal that monetary demand is overpowering the industrial policy concern. This is why I don't think the tariff story should be viewed in isolation. It is one part of a much larger macro equation. The Federal Reserve is one side, the solar industry is another, supply is another, and investor positioning is the fourth. Put them together, and you get a market where silver could experience much larger moves in either direction. And that brings us to the most important part of the analysis. If the tariff creates a temporary shock but solar demand remains strong, the market may eventually look past it. But if the tariff begins reducing solar deployment while the US economy simultaneously weakens, silver could face a much more difficult environment. We'll build the actual bull case and bear case for silver, examine how the solar industry could adapt, and identify which signals would tell us that this tariff is becoming a genuine structural threat, rather than just another short-term headline. Now we can build the real bull case and bear case for silver, because the tariff story only becomes important if it changes the underlying balance between supply, demand, and investment flows. A headline can create volatility for a few trading sessions, but a structural change in the silver market requires something much bigger. It requires a sustained impact on industrial consumption, investor behavior, or the economics of production. Let's start with the bullish scenario. The first bullish possibility is that the tariff has a much smaller impact on global solar deployment than the market initially fears. The United States is only one part of the global photovoltaic market, and manufacturers and developers have multiple ways to adjust their supply chains. If companies shift sourcing, absorb some costs, or move production and investment to other markets, the long-term expansion of solar capacity could continue. If that happens, silver demand from photovoltaics may remain structurally strong. And this is important because the solar industry does not need to grow at an extraordinary pace for silver demand to remain significant. What matters is the combination of new installations, silver intensity, and technological development. Even if manufacturers continue reducing the amount of silver used in individual solar cells, rapid growth in overall photovoltaic capacity can partially offset those efficiency gains. That creates an interesting race. Solar capacity growth versus silver intensity reduction. If solar capacity grows faster than silver usage per unit falls, total silver demand can continue increasing. If technological efficiency improves faster than solar deployment expands, the demand growth rate could slow. That is the real structural question. Now add the monetary side. If the Federal Reserve becomes less restrictive because the labor market continues weakening, Treasury yields could decline and the dollar could weaken. That could increase investment demand for precious metals. And if investors begin treating silver as both a monetary hedge and an industrial growth asset, the metal could receive support from two separate sources. That is the scenario silver bulls want. But now let's examine the bearish case. The biggest risk would be a combination of weaker economic activity and slower industrial demand. Imagine the U.S. economy continues losing momentum. Global growth expectations also decline. Solar developers become more cautious because financing conditions or project economics deteriorate. Then the tariff adds another layer of cost pressure. In that environment, silver could face pressure from the industrial side even if the Fed becomes more dovish. This is where silver can become very volatile. Investors might initially buy silver because they expect lower interest rates. Then economic growth concerns could cause industrial demand expectations to fall. The metal could rise, reverse, and then move sharply lower. That kind of two-way volatility is exactly why silver should not be treated as simply high beta gold. Silver has its own fundamentals. And there is another potential risk that deserves attention: substitution and technological innovation. When silver becomes expensive, manufacturers have a financial incentive to use less of it. They can improve cell designs. They can reduce silver loading. They can investigate alternative conductive materials. They can change manufacturing processes. This does not mean silver suddenly disappears from the solar industry. It means that demand growth can become less sensitive to the number of solar installations. That is a major distinction. If the world installs more solar panels but uses dramatically less silver per panel, the relationship between renewable energy growth and silver demand becomes weaker. Therefore, investors should monitor not just solar capacity forecasts, but also technological changes in photovoltaic manufacturing. Now let's bring supply into the equation. Silver's supply response can be relatively complicated because much of the world's production comes as a byproduct of other mining operations. That means higher silver prices do not necessarily produce an immediate wave of new primary silver supply. This can create an interesting situation. If industrial demand grows steadily, investment demand increases, and mine supply remains relatively inflexible, the physical market can become tighter. In that environment, a temporary tariff shock may not be enough to reverse the broader structural trend. But if industrial demand weakens at the same time that investment demand falls, the supply constraint becomes less important because the market simply requires less metal. That is why we need to monitor the demand side rather than assuming supply scarcity automatically guarantees higher prices. Now let's consider the role of gold. If gold continues outperforming because investors are worried about the U.S. economy, silver could remain behind initially. But if the market eventually moves from fear toward confidence in monetary easing, silver could begin catching up. This is one of the most important potential transitions to watch. The first phase of a macro slowdown can favor gold. The later phase of successful monetary easing can favor silver. Of course, that is not guaranteed, but it gives us a useful framework. If investors are buying gold because they fear recession, silver may struggle to outperform. If investors are buying silver because they expect easier money and stable industrial demand, that is a much stronger signal for the broader precious metals cycle. So what would make me more bullish on silver from here? I would want to see several things happen together. First, evidence that U.S. inflation is cooling enough to give the Federal Reserve more flexibility. Second, Treasury yields moving lower rather than simply fluctuating sideways. Third, a weaker or less supportive U.S. dollar. Fourth, continued strength in global solar deployment despite tariff-related uncertainty. Fifth, evidence that silver demand from industrial applications remains healthy. And finally, silver beginning to outperform gold. That last signal is particularly interesting. If gold is rising, that's constructive. But if silver starts rising faster than gold while monetary conditions are becoming easier, the market may be entering a different phase. Now, what would make me more cautious? If inflation remains sticky, Treasury yields rise, the dollar strengthens, global growth expectations deteriorate, and solar deployment forecasts are revised lower, that combination would be much more challenging for silver. And if silver begins consistently underperforming gold, that would reinforce the idea that investors are prioritizing defensive monetary exposure rather than cyclical industrial exposure. So the market is giving us several signals to monitor. This is not about predicting exactly what happens tomorrow. It's about identifying which scenario is becoming more probable. And right now, the interesting thing is that the bullish and bearish forces are both real. Weak payrolls can support precious metals through changing Fed expectations, but industrial policy uncertainty can challenge silver's demand outlook. Solar growth can support long-term demand, but technological efficiency can reduce silver intensity. Supply constraints can limit production growth, but weaker industrial activity can reduce the amount of metal required. That is why silver is becoming such a fascinating macro story, and if the monetary side wins, the tariff could ultimately become just another temporary headline. But if industrial demand starts weakening at the same time that global growth slows, the market could discover that the tariff was not the real problem. It was simply the first warning sign. I'll put all of these forces together and give you the framework I would use to judge whether silver's next major move is more likely to be driven by the Federal Reserve or by the physical industrial market. We'll also look at what would confirm the bullish thesis, what would invalidate it, and what investors should watch next. So now let's bring the entire silver story together, because the real question is no longer whether the latest tariff headline is bullish or bearish. The real question is which force will dominate the silver market from here, monetary policy or industrial demand. And right now, both forces are moving. The latest week payrolls data has reduced pressure for additional Federal Reserve tightening. That matters because a less restrictive Fed can eventually mean lower Treasury yields, a softer dollar, and better financial conditions for precious metals. At the same time, the polysilicon tariff story has created a new risk for the industrial side of silver, particularly through its connection with solar manufacturing. That gives us two competing narratives: monetary easing versus industrial uncertainty. For gold, the monetary side is usually easier to understand. If labor market conditions deteriorate, inflation begins cooling, yields decline, and the dollar weakens, gold can benefit from several macro forces simultaneously. Silver is more complicated. Silver needs the monetary tailwind, but it also needs confidence that industrial demand will remain healthy. And that is why I believe investors should not simply ask, is the Fed becoming more dovish? They should ask, why is the Fed becoming more dovish? If the Fed becomes more dovish because inflation is cooling while economic growth remains relatively stable, that could be an excellent environment for silver. Lower rates can support investment demand. A weaker dollar can support dollar-priced commodities. Stable economic activity can support industrial consumption. And continued solar expansion can support structural demand. That combination could potentially create a powerful setup. But if the Fed becomes dovish because the economy is falling into a much deeper slowdown, the story becomes less attractive for silver. Gold could potentially benefit from defensive demand and expectations for aggressive easing. Silver would have to deal with the possibility of weaker industrial activity. That distinction is critical. Now let's return to the tariff. I don't think investors should interpret the polysilicon tariff as an immediate collapse in silver demand. That conclusion would be far too aggressive. The tariff is a risk factor. Its eventual effect depends on how manufacturers respond, whether supply chains adjust, how solar project economics change, how much cost is passed through, and whether global solar deployment continues expanding. The most important thing to watch is therefore not simply the tariff headline. Watch the solar response. If solar installation forecasts remain strong despite higher costs, the long-term silver demand thesis remains relatively resilient. If project cancellations increase, deployment forecasts fall, or manufacturers accelerate reductions in silver usage, the industrial demand outlook becomes less favorable. That is where the real evidence will come from. And there is another signal I would watch very closely: silver's performance relative to gold. If gold continues rising, but silver remains weak, the market may be telling us that investors are primarily seeking monetary protection. But if gold rises and silver starts outperforming, that could signal a transition toward a broader precious metals bull market. That would be especially significant if it happens alongside falling treasury yields and a weaker dollar. In that scenario, the monetary and industrial stories would be working together rather than against each other. That is the environment where silver can become extremely interesting. But there is also a downside scenario that cannot be ignored. If inflation remains stubborn, the Fed stays restrictive, treasury yields rise, the dollar strengthens, and global industrial activity slows, silver could face multiple headwinds simultaneously. And if solar deployment also begins slowing because of higher costs, the industrial side could add another layer of pressure. That would be a much more difficult environment. So my framework from here is simple. I would divide the outlook into three scenarios. The first is the bullish silver scenario. Inflation cools, and that reaction is what matters. This is Alex James for Macro Bullion, bringing you independent analysis of gold, silver, the Federal Reserve, inflation, industrial demand, and the global macroeconomy. This analysis is for informational and educational purposes only, not personalized financial advice. Market conditions can change quickly, so always verify the latest prices and economic data and do your own research, DYOR, before making any investment decision.